Imagine that you and a friend decide to go into business together. You start a company, you each own 50% of the company. It could be anything. It could be a restaurant, could be, let's say it's an event rental company. You guys rent tables, just tables.
What was her job?
Tables.
What do you mean?
Just tables!
But your friend is a very emotional person. And he lets his emotions cloud his judgment about the business.
What is her job?
Tables!
How is tables a job?
I can't know how to hear any more about tables.
In particular, he is very hung up on what the business is worth. Every day he's talking to you like, hey man, maybe we could sell the business. What do you think the business is worth? Yeah, one day he thinks it's worth $100,000. The next day he thinks it's worth $200,000. Every day it changes, and it changes based on his mood. But with every price he quotes you, he offers to either buy your half of the business or to sell you his half of the business. You're a long-term holder of the business. You don't want to sell. You want to hold it for the long term. You decide that, you kind of ignore the prices he gives you. So what's he do? He goes out and he's got a bunch of friends who are also kind of emotional, reactive people like him, and they oblige his offer to sell his part of the business. So this guy goes out and he sells the half of the business that you don't own to one of his buddies. And that buddy is very similar to him. He ends up selling part to another guy. And it's like you come into the office one day, some other person has keys to the building, they walk in, you're like, well, who are you? What are you doing here? So, I bought the business. At lunch, he goes out, another guy comes back in, it's a different person. The guy sold his half of the business at lunch. And you're curious about this. You're like, hey, I'm just curious, what did you sell the business for? And the price was, 2 or 3% more than it was yesterday. And then the next guy sells it for 2 or 3% less than he had bought it for the day before. Maybe that morning. Some people are making money, some people are losing money. There's no rhyme or reason to it. Every day your business just continues chugging along, and these people are constantly swapping shares of the business, the half of the business you don't own. Now, you have an idea of what you think the business is actually worth, and what you think it's worth is based on its actual fundamentals. What kind of sales do you do? How much debt do you have? How much equity do you have? How much cash is in the bank? What are your prospects for growing your sales and your profitability next year? But your business partner, whoever they happen to be that day, doesn't see it the way you do. Their price seems to move irrespective of the fundamentals of the company itself. So you sit down at the end of the quarter with your business partners to review your quarterly results. Before you get into the results, your partner offers to buy your half for, let's say, $300,000, or to sell you their half for $300,000 before the results come out. Okay, and you're sitting there and you've got the spreadsheet in your hand, and you're like, okay, well, let's go through the results first before we do that. It's 3:59 p.m. Okay, so at 4 p.m. you sit down and you look at the results together. What happened? Your sales are up 24% from last year. Your earnings are up 160% from last year. Really, really great quarter. You did an amazing job this quarter. And your partner knows it, and your partner's like, wow, I was offering to buy your half of the business for $300,000. Upon hearing those results, I'm going to offer you $315,000. Or you can buy my half for $315,000. I think that's fair based on how we did this quarter. And you're like, okay, that's great. But before, we make a deal, let me add some color to the results. I'm a little bit concerned that, maybe next year our results won't be as good. I think there's a little softness in the market. And your partner hears this and it's like, whoa, hey, buddy. Okay, I was going to give you $315,000. I think I'll give you $280,000 now. Okay, in the course of a second, they went from offering you, 4 or 5% more to offering you, 6-7% less. And the swing in their mood happened at the drop of a hat. Now, let's say the next day your bank calls you up and says, maybe you have a business line of credit with the bank, and your interest rate can change every 6 weeks or so. And they say your interest rate is not going to change for the next 6 weeks. We're keeping it the same. And which is what you kind of expected. So you're like, all right, that's par for the course, no big deal. Well, your business partner hears that and it's like, that's great news. I'll give you 5% more for your half of the business. I'm back up to $315,000 now. And so you're like, oh, okay, Well, another day or two pass, and then some more info comes out on the news. Inflation, the inflation numbers are in. We were expecting 3.3% inflation this quarter or this month, and it was 3.2%. So we did 10 basis points better than expected. 3.2 instead of 3.3% inflation. Your partner goes, "Oh my God, that's even better news." And he's willing to pay you a couple percent more. He's willing to pay you $330,000 now. And so in the course of a week or 2 weeks, you went from being able to sell your business to your partner for $300,000 to $280,000 to $315,000 to $330,000. A $50,000 swing from top to bottom in the course of a couple days, essentially. Obviously, if you're thinking like I am, you might go, "Hey, I could have taken advantage of this situation." When my business partner was kind of really down on the business, I could have bought his share out for $280,000. And then a couple days later, when he kind of changed his mind and started feeling really good about the business, I could have sold back his shares, the same shares he sold me for $280. I could have sold them right back to him for $330. I could have made $50,000 profit in the course of like a week for doing nothing different in terms of the business itself. I would continue operating the business the same way. I would just buy out my partner when he gets really down on the business, or sell to him when he gets overly exuberant about the business. Now, the problem for you, of course, is that you don't know from one day to the next how your partner's emotional state is going to be. So even if you bought it from him at $280, you don't know the next day he might only offer you $260. You don't know he's going to go back up to $330. This is a very irrational person. This is not someone who acts in accordance with their own best interests sometimes. This is not somebody who believes in using the fundamental state of your business as the gauge for its price. This is someone who sets prices based on his moods. Someone who is convinced that his pricing of the business is the correct price. So let's say you think the actual correct price for this business is $300,000, and his price goes up and down above that number, but there is some leeway for putting an exact price on the business. Maybe your sales will be about the same next year. Maybe they'll increase 10% more than you expected. Maybe they'll be about 10% less than you expect. You don't know. And so you would say, all right, there's a reasonable range. It's reasonable to think the business is worth somewhere between $280,000 and $330,000. I don't know exactly, but it's somewhere in that range. You would consider anything outside of that range to give you a pretty nice margin of safety. You might say like, hey, if he offers me to sell his shares for $200,000 when I think the business is $300,000, if you're willing to sell me the business for like 2/3 less or 50% less than what I think it's actually worth, then that's definitely a situation where I would consider buying the business from you. Or if you're willing to pay me $400,000 or $500,000 or $600,000 for a business that I only think is worth $300,000, and I don't see any reasonable path to us to get to that valuation in terms of our actual sustainable growth, I would say, yeah, maybe I'll consider selling to you. I feel like I have a pretty good margin of safety, whether I'm buying or selling, when the prices are way outside of sort of the normal valuation for this business. If you're curious as to who this business partner might be and you're wondering whether or not you want to be in business with them, I'll tell you, you actually have an opportunity to be in business with this person in real life. This person has a name. His name is Mr. Market. Some of you may have picked up on that and been familiar with the metaphor of Mr. Market that was created by Benjamin Graham, back in the first half of the 20th century. Ben Graham, for those of you who don't know, and he's worth a Wikipedia search if you don't know, Ben Graham is the father of security analysis. He basically invented the science and the art of evaluating stocks, evaluating businesses, and determining what they're actually worth. He also, maybe even more famously than that, is the mentor to Warren Buffett. So Warren Buffett went to Columbia University specifically to study underneath Benjamin Graham. And then he hung around and he ended up working for Ben Graham for a few years at his investment firm in New York before he went back to Omaha. And so Ben Graham is well known for his contributions to evaluating stocks. And Ben Graham created this character of Mr. Market based on his evaluation of, or observation, I should say, of what people in real life really do in liquid markets. People really do buy or sell securities at prices that are fundamentally detached from the actual performance of the business or the actual net assets of the business. Selling a business for fundamentally less than what the assets of the business are worth. Like if you shut the business down and you just sold all the tables that you owned, and you could sell those tables for more than what your business partner is willing to sell his stake to you for, it behooves you to buy out his stake. Because even if the business doesn't make another dime, just closing the business down and selling its assets is worth more than what this guy's willing to sell you his stake for. And, the same could be true in the other direction. If he's willing to pay you so much more for the business than the business can earn in terms of money, in terms of sales, and it's substantially more than what the actual assets of the business are worth. So it's like our assets aren't worth this, and we'll never make enough money to justify this price. But if you're willing to pay me that price for this business, then yes, I will sell it to you. Mr. Market is an extremely emotional person, and you do have the opportunity to be in business with him any given day. If you are buying and selling securities that are publicly traded, you are interacting with Mr. Market on a daily basis. Every time you go to buy a stock, Mr. Market is there to give you a price. And every time you go to sell a stock, Mr. Market is there to give you a price. His price will change within 1 second or a millisecond. His price will change. Maybe change like a penny or so, but it will change in some cases rapidly in the course of a minute or a couple minutes. If he hears news that he really likes or really doesn't like. And it's up to you to evaluate whether that news has an actual bearing on the potential of the business. A business does have a fundamental value. It has an intrinsic value. And the easy way to think about this is that a business, all business enterprise, or all assets in general, are worth what they can be converted into in terms of currency. So if a business can earn you $1, you would pay, let's say, up to just shy of $1 for that business. You wouldn't pay more than $1 if it's only going to get you back $1, right? If you paid $2 for a business that only ends up earning back $1 and never earns another dollar after that, you just lost $1 investing in it. A rational person wouldn't do that. So you would only do it if you thought it could generate more than the price you're paying. Or you might do it if you thought somebody else would pay you more for it, but that's speculative. You don't know that someone will pay you more for it. You might think somebody will pay you more for it. But the margin of safety you have is like, hey, yeah, maybe somebody will pay me more for it, but if the thing itself will provide me more money than what I'm paying for it, and the thing itself, let's say, the business could be shut down and the assets it owns could be sold off for more than what I'm paying for it, then that's my margin of safety. The scenario here that I painted is also a real one. So the company I'm describing is not your company. The company I'm describing is Meta, which is, of course, a parent of Facebook. So I'm creating this video at the start of Q4 2023. Meta, Facebook, just at the end of October, came out with their Q3 results. And they were great. On paper, 24% increase in revenue versus Q3 of 2022, 160% increase in earnings. They blew expectations out of the water. Their stock, in the immediate 4:01 p.m. release of their earnings, their stock jumped up 4 or 5% in after hours trading. People were elated when they saw the numbers. And then they had an earnings call. And on the earnings call, the CFO for Facebook gave a word of caution and said, we see some softness in the market. We don't know what our numbers will be next year. There's some global macroeconomic things going on. We don't know what the advertising space is going to look like. And so they added a word of caution. Adding the word of caution caused the stock price to go from going up 4 or 5% to dropping 4 or 5, 6% or more. Now I want to pause here to give a really good illustration of how fickle Mr. Market is. This is a screenshot from Bloomberg.com on the day that Meta posted their earnings. So they ran an article that Meta shares rise after revenue beats analyst estimates, and that's true. Their stock jumped about 5% in after-hours trading after they had posted their earnings at 4 o'clock. When you clicked on that link around 6 o'clock, it redirected to this article, Meta shares slide. So in the course of an hour, what happened was their stock jumped up 5%. It then reversed course when the CFO gave a little bit of negative commentary, and they had to rewrite this article to say the shares were now sliding in price. Mr. Market's mood changed so fast that Bloomberg didn't even have time to update the link. So the stock had been trading over $300 a share. It dropped, I think, as low as $278 a share in trading the next day. And then in the couple days after that, people thought, maybe we overreacted a little bit. The price started to come back up. And then the Federal Reserve Chairman, Jerome Powell, came out and said that the Fed would not be raising rates after their most recent meeting. And so the stock market as a whole, including Meta, jumped up several percentage points higher. And then a couple days later, we had the CPI, the inflation reading come in for the month. And the month of October, we had been expecting 3.3% inflation, and we got 3.2% inflation. So it was 10 basis points better than expected. And when that happened, the market jumped up again a couple percentage points that day, and including Meta. So you went from being able to buy Meta from your business partners who were willing to sell their shares to you at $278 a share to now $330 plus a share in the course of several days. So you could have bought shares at those prices. You could have sold your shares at those prices. The point is that the fundamentals of the company did not change. The leadership at the company is exactly the same as it was the day before. The business plan of the company is the same as it was the day before. There's no significant material changes to this company, other than the market has decided to react aggressively in one direction or the other. But everybody thinks at any given moment that that price is the right price. I think this is an important concept to understand, that the price of a company is set by the people who are willing to sell their shares. Long-term holders are not setting the price. The price is being set by everybody else. If you think of somebody like Warren Buffett, who owns Berkshire Hathaway and has never sold a share, he's donated shares, but Warren Buffett has never sold a share of Berkshire. So the price of Berkshire, if you wanted to buy a share of Berkshire at any given moment, is not being controlled by Warren. Warren is literally not offering to sell it to you at any quoted price. No one has ever quoted a price to Warren Buffett that enticed him to sell a percent of his ownership stake in the company. The price for Berkshire at any given moment is being set by whoever happens to be an owner who is willing to sell at that price at that time. And so when you think about, the price of Meta stock or the price of your privately owned table rental business, it's kind of a funny image to think of yourself as owning half and then your business partner and all these other random people trading his half of the business and at various prices at any given time. And you're sitting there with your half of the business and you're like, I'm not offering my half for sale. I'm continuing to hold it because I think this business will continue to grow. And nobody's giving me a price that is so ridiculous that I'm willing to exit it and do something different with my life. Maybe go do chair rentals instead of table rentals. But the concept of a liquid market and the pricing, like price discovery, like enough people acting in the market are going to help the true price be discovered here, is something you can use to your advantage, because it is on its face a little bit like it's philosophically interesting, but it's a little bit ridiculous. Like anyone who's selling at that moment believes that maybe there's some other better use of their capital than continuing to own. And somebody who's buying believes there's no better use of their capital than owning. Like the act of choosing to sell means this is not the highest and best use of my capital. And the act of choosing to buy is to say this is the highest and best use of my capital. for what options are available to me at this given time. Of course, nobody happens to know what every option, like we are human. We're not able to evaluate every option everywhere in the world at every given moment. That would be a truly efficient market, but that doesn't exist. Human actors and algorithms for hedge funds and whatever are what happen to drive markets. And your participation in a market can be determined by you. To summarize another metaphor that Warren Buffett famously gave, investing is like a game of baseball where there are no called strikes. You can stand at the plate and watch pitches come all day long and you never have to swing because you will never have a strike called. The only time that you strike or strike out is if you swing and miss. But you'll never get penalized for not swinging. And so you can sit there all day long and let people offer you quotes for the business that you own. And you can decide if that's so ridiculously cheap that there's enough of a margin of safety that you're willing to invest in it. Or you can decide if it's so ridiculously expensive or overpriced that the business you own will never live up to those expectations, and you might as well get out now because there's no price anyone will ever give you that's better than that. Or maybe somebody would give you a price that's better than that, but the business itself can never justify that price. Or the likelihood that it would justify that price is so low that it's not worth the risk. So the lessons here are to take advantage of Mr. Market. Mr. Market is your business partner. He is not just a metaphor. He is your business partner. Every time you buy and sell a stock, you are interacting with Mr. Market. And you can determine whether you are part of the corpus of people that make up Mr. Market, or you can be someone who invests to your own advantage, irrespective of what Mr. Market is doing, and irrespective of whether or not Mr. Market and all his friends think his price is the correct price. You can determine for yourself, using the facts and the data that are available to you, whether or not the price that's being offered for a business is a fair price, whether or not you would pay it, whether or not you would give up your stake for that price. Hey guys, I'm David. If you're new to my channel, please subscribe or like. If you enjoyed this content, we talk about finance, stock market, investing, personal finance, behavioral economics, all sorts of fun and interesting topics that I like talking about. And if you like listening and engaging in the conversation, then please leave a comment. Please share your thoughts, and please subscribe, like, and join us for more content in the future.
And I don't want any questions about the tables.